We've obviously seen some rocky days in the market, and the start of the Ukraine-Russian war also exacerbated that volatility. But there have been some strong days in the market as well. Do you think we've seen a bottom? And if not, what will it take for us to see a bottom?
They say there's two constants in life, and that's death and taxes. Nowadays, it seems like inflation can be added to that mix. Will this ever end? And if so, when will it end? The target rate is 2%. And guess where we're at now? Let's take a look at this chart where inflation has accelerated to a 40-year high to around 7.9% back in February. Seems like every day we're hit with new inflation news. Recently, we started experiencing the Fed's first rate hike since 2018 in hopes of beating inflation down. Will the Fed save us, or will we need a life raft somewhere else? Meanwhile, CNBC says the first hike won't be as significant as it will be in the coming months. But how long will this last? How much will it cost us? And what are the things we should wait for? In this video, we'll go over 3 key points regarding inflation with Captain Noto and Sofi's head of investment strategy, Liz Young. We're not financial advisors, and this isn't financial advice, so always do your own due diligence. Also, for you hardcore Sofi investors out there, we're launching our Sofi focused Patreon this week at April 20th at exactly 4:20 p.m. California time, or if you want to get technical, PDT. At this point, we've created well over 130 plus videos on Sofi since the IPOE days, so if you want to know our price targets, buy ranges, see our entire Sofi position and stocks on our personal watch list, then be on the lookout for our Patreon coming soon. It will only be open until April 30th. We want to keep it small as this will be our first time opening our Patreon. Along the lines of businesses trying to recover their losses and consumers getting ready to splurge their savings, prices keep flying, and we all know where it's coming from. It's no surprise that life is completely different now than it was 2 years ago, pre-illness. It seems like there's no end in sight, but Sofi CEO Anthony Noto speaks with head of investment strategy Liz Young about the existing inflationary environment and how this could affect you. Without further ado, let's get right into this. You've probably heard that we could measure inflation in a lot of ways, and Liz reminds us that it's always from the perspective of a consumer. There are actually 3 points about the current inflation we have. First up, pressure on consumer prices. We've got the Fed, who's going to have to solve this pressure. More pressure often leads to collateral damages. Here is a fun fact. Did you know that 70% of the US economy is made up of consumer spending?
I'm just trying to say, I'm... There's gotta be an easier way to do this.
Are you wondering what it looks like when consumers like us pile up cash in our banks and don't spend a single cent? It's like we're the whales of Wall Street, but in this case, it's us against the US economy, and whenever we stop investing, aka burning our money, the stock crashes because the demand drops. All of a sudden, we're living in chaos when it's the economy that we're talking about. It slows the growth we need in the economy as it plays a huge job in economic expansion. So basically, what the government is saying is, saving, spend money, it's the American way, baby. But going over the technical details, here's Liz Young.
Just to put some numbers around it, from peak to trough, the NASDAQ was down about 22%. From peak to trough, the S&P was down about 13%. That's a pretty big drawdown given what we've been used to over the last 18 months to 2 years. In reality, those aren't big drawdowns over the entire history of the stock market. So the S&P has an average drawdown of about 13 or 14% every year. So a 13% drawdown is really not that bad.
On top of that, consumers are already affected by the overwhelming news of inflation every day. But one thing that Liz noted was that consumer confidence in spending is influenced by what they know about inflation. And when asked whether this affects the spending yet, there will be a lag in how it affects their spending. Just the same as how the Fed is trying to take care of inflation with rate hikes. Many people losing sleep over the status of the US economy will have to look at how much consumers spend on energy, at what point will it break, or at what point will they have to pull back on their spending, considering the round-the-clock war on Ukraine and Russia and a lot more issues.
It's right around that 4.5 percentage point mark. So if they're spending above 4.1%, so 4.1 to 4.5% of their discretionary income on energy, that's where they start to say, whoa, this is too much. I have to slow down. We're not quite there yet, but we're close. We're probably at about 4% of discretionary income. Now, we can hum along at 4% and be okay for a while, but we're right on the edge. So it's definitely something to watch for the next few months.
We're no econ majors, but hearing this,
and this is still pretty narrow. This is a fragile place for the yield curve to be heading into a hiking cycle.
Yield curve? This is the only curve we know. For the rookie investors out there, the yield curve shows future prospects of economic growth, a thing we can rely on when we're looking at inflation and at the Fed. It's the shape of the yield curve that people like Liz check out. Usually when we lend money, we should earn a lot more on interest when it takes longer years to pay us back. But Liz talks about this concept called inversion, aka the doomsday for the economy. It happens when you compare a 2-year and a 10-year treasury bond, and the yield of 2 years is much higher than the 10-year bond. A healthy economic scenario happens when there's more yield from longer years of lending, but in the case of inversion, it's just misery signaling a market recession. But then Liz reminds us of this one thing we should look forward to. Inversion, just like
great success,
doesn't happen overnight.
Because it's a natural part of the cycle, at some point there will be another recession. Shortly thereafterwards, there will be a recovery. That's just how this works. It's a matter of what put us into the recession and how quickly we can come out of it.
As Liz says, the market holds up well between inversion and the actual time point. Liz said it's not something where you should take your money out of the market and you should stay invested through it. We've seen Sofi hit its all-time bottom since it went public, and we know that we've all been waiting for this bottom to end. Has it ended, or will it be the one to end us? Bottoming is a process, she said. Just weeks ago, it seemed like everyone was down bad buying tons of put options like it was a Black Friday sale. We know what you're thinking. When's it gonna end? There's actually no definite answer to that, but we'd have to see the flows moving out of the sector funds, and this is what happened in the technology, communication, and consumer discretionary.
And not that it's a good thing that flows are accelerating on the outward, but it's a good thing in the sense of, okay, people have maybe flushed everything out that they can in fear, and that starts to feel like a time when the bottoming process is getting to an end.
The first rate hike has been dropped, increasing rates by 25 basis points. But what does it mean? Most of the investors in the market actually haven't seen this before. The last time we were on a one-on-one with inflation was in 1982. The only difference between then and now is the Fed was saving us like a superhero, but now it's restricting us and saying we can't cry to our mamas anymore. But actually, Liz left an important note right here. It doesn't mean that the Fed's rate hikes are telling us that the market is about to go down and everyone is doomed with nothing but piling losses.
And, we continue to hear comments from the Fed about controlling inflation, and they are laser focused on controlling inflation. I think that is what they should be doing, because if inflation stayed high, it would break the economy by itself. So they should be controlling inflation. I mentioned at the top that even that idea, though, there's going to be some collateral damage, and that collateral damage is what we would call a re-rating of different parts of the stock market. So you've seen a lot of pressure on parts of the market like growth, particularly technology and communications and consumer discretionary, because there was so much froth in a lot of those prices.
So if we're not in a final battle with the big boss, aka the recession, what are the things we should expect as an investor? Even if consumer spending is now getting back to normal levels, Sofi's head of investment strategy is still on the lookout for possible flaws that can take us by surprise.
So one of the things that we keep hanging our hat on is that demand is still so strong in the U.S. economy. The U.S. consumer has $2 trillion in cash built up because of the pandemic and stimulus that occurred and the inability to spend, and they still have all this pent-up demand. And I think consumers are depleting their savings. And also something that you're starting to see trends of, I know that we saw trends of this when we looked at some data from the Sofi platform in the holiday season. People are spending more money on services and experiences than they are on goods compared to last year.
But like our patience, money runs out. So we have to keep our eyes on spending levels, consumer credit, how quickly people are paying out of their debts, and all that jazz, as these little indicators of consumer health and behavior will define what our economy will be in the next 6 to 12 months. Ladies and gents, the Fed is telling us that inflation will stay here for a while, and it will hurt not only simple investors like us, but also giants in every industry. And in the words of Liz Young, there's going to be a lot of scrutiny on earnings growth, and it will slow down.
We don't necessarily see the fruits of that labor, so to speak, until 6 months out. So they have to wait and see how it affects things, and it's going to take time. The market, as we all know, is moving minute by minute, day by day, hour by hour, and it's tough to hold on to our seats and watch some of those gyrations just pass us by. But in this kind of period, you're going to have to, because there's going to be bumps, and it's not going to be necessarily a smooth transition from loose monetary policy to tight.
Shout out to the people who showed us support on our previous video: Jong Lim, Joy Luna, Carolyn Nunez, and Ilyan Yordanov. We appreciate it. For those of you who are hungry for more SoFi content, make sure to check out our Patreon, which will be dropping 4/20 at 4:20 p.m. California time. In there, we'll reveal our entire SoFi portfolio along with our price targets and buy ranges. Also, of course, we'll have a SoFi private Discord chat so we can stay in touch with our fellow trench warriors. That wraps it up for today's video, guys. What are your thoughts on this video? Are you long SoFi like us? If you found any value whatsoever, smash that like button for the YouTube algorithm and subscribe if you haven't already. Until next time, peace.